Skyworks Solutions is a leader in 5G, providing all kinds of products for the smartphone and for the mobile device market. As you can see, the company has a very enviable record of growth, a little bit inconsistent, but very fast. It's grown earnings at over 20% a year since 2005, and you can see that by simply following my mouse. The company initiated a dividend in 2014. The company has a September fiscal year. And so far, they've increased that dividend every year up until 2022. But the opportunity that the bear market has brought us has been really intriguing for Skyworks Solution. As you can see here, when I put weekly closing stock prices on the graph, the market has had a penchant to value this stock between 17 and 20 times earnings. That's the blue line and the orange line on the graph. Currently, it's trading at a blended PE of 8 times earnings, or roughly half of even their most low valuation that the market's applied. The company now offers a 2.48% dividend yield, has very reasonable debt at only 31% per capita, and the company has fallen precipitously, as you can see, which I consider to be a major overreaction. Morningstar gives this company a 5-star rating. They consider their fair value at around $180 a share. That would be consistent with it moving back to approximately a 17 multiple, which would put it somewhere between $170 and $190 a share. The company is expected to continue growing and is expected to benefit dramatically from the rollout of 5G, which is in the very nascent stages of development today. This is a true bargain brought to you by the market. The stock was already reasonably valued before this market started to correct, and it has now become, in this author's opinion at least, extremely undervalued. Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, aka Mr. Valuation. Once again, I'm very excited and proud to bring you a Subscriber Request Tuesday. Now, a couple of things about these Subscriber Request videos. Subscribers asked me to look at 47 stocks. And as I've mentioned in previous videos, it's really impossible to cover that many. So I've whittled that down to 20 stocks that I think offer some intriguing insights into the markets and also provide lessons in valuation and just general investing, if you will. But I also want to make another point that as I go through this many stocks, I'm going to cover 20 in today's video. I want you to realize this would represent the first step prior to a more comprehensive research and due diligence process. I haven't done extensive due diligence on all these, although I have done it on some of these. But the point is, it's up to you to decide, whether or not you think the company looks intriguing or not. I'm not, in other words, recommending these stocks. I'm simply pointing out what they look like in today's market, given the correction that the bear market has brought us, and it's officially now we are considered to be in a bear market. Market looks pretty strong today, but that's here and there. So let me go ahead and go into the fast graphs here and show you the 20 stocks that we're looking at. The 20 companies we're looking at come in various sectors and sub-industry sectors. I have some aerospace and defense, some diversified REITs, utilities, healthcare equipment, packaged foods and meats, railroads, retail REITs, semiconductors, soft drinks, specialty REITs, and steel. So as you can see, the subscriber, have asked for a very diverse group of companies this week. As usual, I'm going to go through these in alphabetical order because I think it's basically the easiest way for me to do this and still control what I'm going to look at. So I'm going to go into the summary here, and let's start with American Tower Corporation. Now, American Tower Corporation is a specialized REIT, and as such, we like to look at this differently than a lot of stocks. If you look at it with adjusted earnings, the valuations make no sense. If you look at it from a standpoint of operating cash flow, or AKA funds from operations when you're dealing with REITs, which is the primary metric, you can see that starting, back to 2002 and going all the way up through 2018, this company sold at about a 18.78. That's the multiple of the orange line. It's say an 18 to 20 or 21 multiple. That was the normal valuation for this company. But in the last couple of years, it got pretty fully valued here, as you can see. It had a quick flash crash in COVID, but it really recovered almost immediately, and then it fell again. And more recently, it's been in a downtrend. I think this particular stock, although an extremely high-quality REIT, offers a 2% dividend yield. This was one of the few REITs that offers a lot more growth. It's investment grade rated, BBB-, which is very good. The company is expected to grow at a rate of about 7% a year going forward. The long-term growth rate is a little more generous at about 10%, but I do believe that the REIT is currently overvalued right now. It has a lot of promise in this REIT. It's obviously a tower REIT, cell phone towers, etc., but I do think the company is overvalued at today's levels. And you can see based on historical norms, it certainly looks that way. Just quickly look at the fast graph. Now, there are other metrics you can value this with also, as is with all stocks, and sales, because this has been a very fast-growing company for a REIT, especially if I shorten the time frame here. You see that it's grown at double-digit rates. So it's getting close to its normal price to sales of about 10 times sales, but it's still just a little bit pricey at current levels. The next company we're going to look at is Broadcom, symbol AVGO. Broadcom is a very interesting company, in my opinion. It, too, has had very strong growth. It does offer over a 3% current dividend yield. But note the market's penchant to value this at around 14 or 15 times earnings, which I consider to be a relatively normal PE ratio. I'm looking at this time frame going back from 2012 forward, and this has an October fiscal year. The market has valued this at around 14.7. We'll call that 15 times earnings, round numbers. The company has an earnings yield of 6.7% currently, which I think is attractive. It recently got a little bit overvalued. I do believe it's fairly valued today. A lot of ways to look at this company. It's a high dividend yielding company. If you look at it from operating cash flow point of view, operating cash flow has covered the dividend like a blanket. If I look at free cash flow per share, free cash flow is also generally covering the dividend. I don't even care about price so much when I look at these cash flow numbers for these dividend-paying stocks. What I'm really looking at is to see, is the orange line, the free cash flow in this example, is it covering the white line, which is a dividend? And as you can see, it's doing that very nicely. Now, there is a valuation reference that can be made with a company like this using cash flow too, but I think its primary benefit with these cash flow numbers, and EBITDA is a softer form of cash flow, is to look at it from a standpoint of good solid dividend coverage and good valuation. Based on a normal price to EBITDA, the company looks cheap currently. On price to sales, the company still looks a little bit pricey, so that's one metric where it fails a little bit as its sales growth has slown ever so slightly. But generally, I think looking at this company, I believe it's very attractively priced given the expected growth rate. If we look at its normal multiple of around 15 times earnings, which is conservative, this would still give us double-digit rates. We don't necessarily get a great margin of safety here, but I do think this company has been very attractive. And again, this is another gift that I think the bear market has brought us, especially in the tech sector. Now, Boeing was one that everybody has asked for. Now, Boeing is a conundrum to me. This is not the kind of stock for a buy and hold investor like yours truly that I would be interested in taking a position in right now. I may someday. Prior to, going back, from 2018 back, it really was a pretty decent and consistent grower, certainly the leader in aerospace and defense, manufacturer of all these jumbo jets. Then they had the problem with one of their big jets. You saw the company got destroyed in COVID. The big problem I have is their earnings and their dividend has disappeared. And so consequently, right now, a lot of what's going on in this company I would consider is uncertain. We really don't know what the future will hold. I do believe the company will survive. I do believe it will probably begin growing itself again, but I just don't know if it makes any sense to be taking a position now. In other words, my position would be there's a lot of risk in investing in Boeing now. It's a great company. It's been an iconic company for many, many years, but recent trials and tribulations have really caused some issues with this company that I think investors should maybe look elsewhere if you're a long-term buy and hold, especially a dividend investor, which doesn't work. B&G Foods is packaged foods and meats. You can always go to the company's website directly from the Fast Graph research tool, and you can look at, some of the major products that the company offers. So you might not know it by B&G Foods, but you would know it by Green Giant, Cream of Wheat, Crisco. Some of their major brands would be things that you would, recognize this company for. A little bit cyclical, relatively volatile. It does offer an 8% dividend yield right now. The dividend payout ratio is actually over 100%. It's been that way for the last couple of years. Looking at it from an operating cash flow point of view, The company doesn't cover its dividend with cash flow, so there's a lot of cyclicality here. It's only a B-rated company. It has 71% debt. So, the numbers look good when you're looking at a 13 price to cash flow, for example. And similarly, if you're looking at a 13.4 price to earnings with a 7.4% earnings yield and an 8% dividend yield, that looks pretty good. But I do think you'd want to take into consideration a lot of these other issues that I've mentioned. The company does look inexpensive today at these prices. I'm looking at forecasting. It's expected to have very low growth for the next couple of years, and there's not giving any long-term growth rate from the analysts reporting the FactSet. So I'd be cautious with this one. The numbers look real good, but you have to ask yourself, are you willing to take those kinds of risks? Now, the Chinese growth stocks, Baidu being one of the major ones, Tencent, there's a lot of them that have suffered recently. They ran into some real trouble with the Chinese government, and that created a great deal of uncertainty. That seems to be easing up a little bit. The stocks have therefore become very inexpensive relative to historical norms and historical growth. You can see this correction has done that. Going forward, they are expected to begin growing again, perhaps double-digit rates, really strong growth on a long-term basis. But there's a lot of risk, a lot of uncertainty in these Chinese companies. It'd be up to you whether or not you want to take the risk. Recent performance, I might add, with all the growth and all the uncertainty, has actually been negative for the last decade or so. So these are stocks that I would consider that investors need to be very careful with. It's really hard to trust everything about what you see with Baidu compared to a quality New York Stock Exchange listed stock. Clorox is an iconic stock. They benefited greatly from the COVID, as you can see, and of course their price reaction was strong. It was actually even better than their earnings growth. The company's earnings now are expected to drop. The company's been in a free fall. The market likes to value this at a high PE ratio relative to its growth. From a standpoint of cash flow, since it is a strong dividend stock, it does cover their dividend with their cash. They're yielding 3 3/4, almost 4%. If you bought it, could buy it at yesterday's price. The stock is showing strength here in the recent market, up about 1%. So, that's good. But if you look at it from some of these other metrics, in addition to cash flow, price to sales has now become attractive, which is, kind of a plus. The cash flow numbers look pretty good. Price to EBITDA is still a little bit high. So, Clorox is considered an iconic stock. The market does like to put a premium valuation. But the real question you'd have to ask yourself is, what's going to happen to future growth here? That's where all the uncertainty is. It's actually expected to be a negative grower looking at the longer run forecast. So consider that when you're doing your research on this one. Chevron, the oil companies have really been a conundrum to me. They've continued to pay dividends, even though their earnings have been all over the place due to a lot of the energy policy and what's been going on with oil and gas prices and the price of crude oil, et cetera. They have had a pretty good year. They've recovered pretty strongly. Currently, if you look at today's marketplace and just get a, quick quote, I'll use Google Finance here. It's up almost 4% today. Exxon looks very similar to this. I will be covering it briefly. The real thing here in me is the dividend yield is almost 4%, and the cash flow has been covering the dividend even during the COVID years and the really kind of strict energy policies that the company's been faced with here recently. Their free cash flow is another story. They haven't really covered their dividends with free cash flow, but it's a AA rated company. It does have a strong balance sheet. It's been able to maintain their dividends, I think, based on, on retained earnings and simply the strength of their balance sheet, et cetera. But there's still a lot of uncertainty in these, integrated oil and gas, major oil and gas producers. Chevron being one of the best. Hershey's is a very interesting stock. This company, as you can see, had a premium valuation by the market. It's been a very consistent grower. It has a very consistent dividend growth rate. It's averaged almost 9% dividend growth historically. So, the market has always been kind to this company. I think that's something to understand. From a standpoint of operating cash flow, which it has a little better valuation metrics when you look at it from cash flow. It does look very expensive today, however, relative to even its historical norms. On a free cash flow basis, the dividend has been covered by free cash flow, but in some years just barely. If I look at it from a price to sales point of view, the price to sales looks very, very high to me right now. So Hershey's is, clearly considered a blue chip. It's A-rated. The market likes to value it high, but I do think it's premiumly priced right now. I wouldn't be taking a position in Hershey's today because I think the valuation is too high, but I've always found it very hard to invest in this stock because of the value you had to pay to be able to participate in it. Illinois Tool Works is one of my favorite companies. It's A+ rated, somewhat cyclical, but really it's a growth stock, averaged almost 9.5% growth long term. Market usually likes to put a 20 multiple on this stock. If I look at it from the standpoint of operating cash flow, they really cover their dividend beautifully. And the valuation, when you can buy it at something like 15 times cash flow, that turned out to be a good buy. Unfortunately, it's currently trading at 20 times cash flow. Their free cash flow per share has also been covering their dividend beautifully over all the years. If I look at it from a standpoint of price to sales, it does look very expensive today, but Illinois Tool Works is one that is beginning with this correction to come into ranges that you might want to start getting ready to take a look at it if you're willing to pay the premium valuation. It's getting close to a 2.7% dividend yield. It does have a very low earnings yield, in my opinion. I like to see 6.5% to 7%. But again, it's a kind of a quality premium commanded company. The next stock is Lockheed Martin, like a lot of the defense companies. We went through a period where they were really being valued very low by the market. You can see, even though you didn't make a lot of money for a couple of years, that eventually was a great time to buy it. I think the stock is a little pricey. The correction is making it look a little bit better. I still think it has some room to drop. I don't consider it necessarily overvalued, but I do consider it fully valued at these prices. So I don't see any bargain here, but I do like this company. I think it's a great company. If I look at Realty Income, now this is a REIT, one of the highest quality REITs in the country. The market has had a penchant in recent years to price it at about a 17 multiple. It's about 18 times FFO right now. This is the monthly income company. They pay monthly dividends. If I look at AFFO, now remember one thing about AFFO, it's not as consistently applied as funds from operations. Everybody has their own little unique formula, so you want to look closely at that when you're evaluating the stocks. I don't think Realty Income is excessively expensive today, but I don't consider it a bargain. I wouldn't be buying it today. I'd be looking for a dividend yield somewhere in the 5.5% range if I could get it, if the price keeps coming down, before I'd be an investor. But it's certainly a high-quality company and one of the higher-quality REITs out there. Next one is PepsiCo. I'm going to look at it from an operating cash flow point of view. This might be the best way to value Pepsi if you really want to own this soft drink company. You can see it's got a really good dividend record. It's got a very reasonable payout ratio, paying out about half of their earnings. The cash flow yield's about 5.5%. I do consider it pricey based on its normal operating price to cash flow. Looking at it from an earnings point of view, the market has always priced this at somewhere around a 20 multiple, just except for the few years coming out of the Great Recession. It's trading at a premium to that right now, so I like Pepsi as a company with the snack foods and the soft drinks, but I don't consider it a bargain right now. And there's also risk. The soft drink industry is really under a lot of attack by nutritionists and people who, are against the sugar craze that we've had and the obesity epidemic. And certainly companies like Pepsi have been major participants in that. Now, Southern Company is a utility. It's very important to recognize utilities are income vehicles, so you want to buy them when their valuation is at least fairly valued at around 15 times earnings, or better yet, if you can catch them at these times when it's slightly undervalued. You don't make a great deal of money here, but you get a good solid dividend, a good dividend record. Unfortunately, I think this company is currently overvalued. Therefore, I'd not be buying Southern Company today, even with its 4% dividend yield. But if I would get it down, if I could get it about another 15 to 20% cheaper, then I think, this might be an interesting play for those of you who are looking for current income. It's a very good utility, BBB+ rated, one of the better utilities out there in my opinion, but I just think the company's expensive at today's levels. Remember, these are low-growth vehicles that offer a primarily yield. Skyworks Solution was the feature. This is by far my favorite stock in the whole group. According to Morningstar, they're a leading supplier of a variety of radio frequency components, the smartphone makers and other electronic makers. They earn the majority of their revenue from mobile products, mostly from a variety of products that switch, filter, and amplify wireless signals in smartphones. The The 5G network presents a boom to them. The only thing that I can think of with Skyworks was, there was a negative article in Barron's magazine not too long ago, back in May 4th, that said they issued weak guidance. But what I found ironic about that was the guidance was weak, but it was still pretty good guidance. We were looking for good growth. I don't see anything really bad happening to the fundamentals. They slowed down a little bit from just a feverish growth rate in 2021. Remember, this has a September fiscal year. They're expected to grow about 6% this year, 11% the following, and 7% going forward. Their long-term growth rate is much more generous at almost 12%. I think this stock offers yield at almost 2.5%, earnings yields over 12%. The company has about 31% debt to capital, and I think it provides a tremendous margin of safety. I would recommend this stock personally to anyone that's looking for capital appreciation and total return, income growth, etc. This is one of my favorites in the group here today. Stryker has been long a favorite of mine. This is a healthcare equipment company. They make defibrillators and other, heart devices. It's been a really terrific company, for a long, long period of time. You can see they operate all over the world. If I go into a little deeper into the website here, they have medical and surgical equipment. They're a leader in that. They have, they also sell bed frames. You'll see Stryker equipment, orthopedic disposables, stretchers and transport chairs. They really supply the hospital and healthcare industry, one of the better brand names out there. The market likes to value this at a premium, although it didn't coming out of the Great Recession years. If you look at it from a standpoint of operating cash flow, it really covers its dividend beautifully. It does generate free cash flow that also covers the dividend. Based on a price-to-sales basis, the company is now starting to look attractive. So if you're interested in that and feel comfortable with that, it could be a good buy. It's trading below its historically normal valuation, but it's still a little bit high. Looking at the futures, expected to grow about 9%. If you use the normal multiple the market likes to apply over the last 5 years, have been about 25. But let's shorten that to about 21, which I consider to be more realistic long term. It would be an attractive time to buy the stock with a 1.5% dividend yield if you're looking for a really high quality, company in the healthcare industry. But, you normally have to pay a premium to buy this stock. But I don't consider it a great bargain. I consider it still fully valued. UnitedHealth, I love this company from a standpoint of consistency of growth. Offers about a 1.4% dividend yield, a rather low 4.48% earnings yield. The company has 34% debt roughly. It's A+ rated. You can see the price has followed the earnings. I do consider it overpriced. It has had a correction, but I think this one still has a long way to go. From a standpoint of the cash flow covered, the dividend, very strong there. If you look at it from price to sales, it still looks very expensive. So this is a great company. This is one that's worth waiting for. I don't think it's a good buy today. I do think it's still, I would technically call it overvalued rather than fully valued. Union Pacific is almost in a very similar situation. It's an A- rated company, one of the leading railroads in the country. You can see the market has always valued it at 15 times earnings till we hit this recent, rather irrationally exuberant market. It's coming back down to the normal PE for the last decade or so. You can see that, right here. But I still think the stock is very expensive. Their forecast growth rate is about 12 or 13%. If you applied the normal multiple, that would make it inexpensive here. So if you're willing to take that risk, I would say, now would be an entry point that might make sense. But for me, I still want to wait before I'd be wanting to get involved in Union Pacific. WP Carey is a diversified REIT. Again, we got to switch to operating cash flow. I consider this one moderately overpriced, not dramatically overpriced, but moderately overpriced. It's primarily an income vehicle. If you look at it long term, you can see that it has produced a significant amount of income relative to the SPY ETF. It's also presented growth that was equal to or better than it. So it has a preferential rate of return, but I do consider it slightly overvalued here. Forecasting wise, it's not expected to grow very much, but it does offer a very nice dividend yield of about 5.1%. I would, personally like to see a better entry point for WP Carey for my money, but it's a good REIT. U.S. Steel is just simply, I wanted to show this because people keep asking about it. Great, one of our great iconic steel manufacturers, been around for a long time. Very, very cyclical. As you can see, I'm looking at cash flow here. It looks likewise the same with earnings. From a performance point of view, you can see that even if I just get out the really highs and lows, this company has generated very little in the way of performance. This is certainly not a buy and hold stock. Very hard to trust, what it might do if you look at it from an analyst scorecard. Analysts miss the estimates very much, so you don't really have anything to rely on there. I just pass on heavy metals and steel companies. Exxon Mobil, I kind of promise you, I showed it looks very, very similar to Chevron. As you can see, from a standpoint of cash flows and so on, the company looks like at least they're covering their dividend. From a free cash flow point of view, it's a little bit more, sketchy. It's hard to say what's going to happen to the oil and gas industry in coming years, but they certainly had a good run the last year, but that also might make them a little bit expensive. Anyway, this has been Chuck Carnevale, a.k.a. Mr. Valuation, bringing you another Subscriber Request Tuesday video. I hope you enjoyed it. I covered, 20 stocks. Remember, this was just a cursory, look at them. This was to help you determine if you want to spend the time researching any of these stocks deeper and further for yourself. There are some good investments, I think, in this group that you asked for. A lot of different diversity, a lot of lessons on valuation and investing in general. So I hope you enjoyed that. If you did, ring the bell, subscribe to the channel, give me a like, of course, and take a look at Fast Graphs. I think you can really see the value of this tool by looking at some of these diverse companies that I've been covering in these request videos. Anyway, thanks for watching. Talk to you guys again real soon.